Hello and welcome to our channel, The Loophole. While you paid taxes on every dollar you earned last year, some of the wealthiest people on Earth paid nothing at all. This isn't a crime. This isn't even a loophole. This is the system working exactly as designed. How is it possible that a teacher earning $50,000 pays a higher tax rate than a billionaire who added $5 billion to their fortune? In June 2021, ProPublica published leaked tax records showing that America's wealthiest individuals paid little to no federal income tax for years. ProPublica Investigation 2021. Jeff Bezos paid $0 in federal income tax in 2007 and 2011. Elon Musk paid $0 in 2018. Warren Buffett, one of the richest people alive, paid a tax rate lower than his secretary. These weren't violations. These were legal strategies built into a century-old tax code that treats wealth and income as two completely different things. This matters now because wealth inequality has reached historic levels, while public services face chronic underfunding. The disconnect between what ordinary people believe the rich pay and what they actually pay has become one of the defining economic debates of our time. The system isn't broken. The question is whether it was designed this way on purpose. The foundation for modern billionaire tax avoidance was laid in 1913 when the 16th Amendment established the federal income tax. The key word is income. The tax code was designed to tax money you earn through work or investments when you sell them. It largely ignores wealth that simply grows on paper. For decades, this distinction didn't matter much because most wealthy people eventually sold assets and realized income. But starting in the 1980s, a new financial architecture emerged. Wall Street developed sophisticated lending products that allowed the ultra-wealthy to borrow against their assets instead of selling them. If you own $1 billion in stock, you can borrow $200 million at low interest rates and never trigger a taxable event. The 2000s saw this strategy become standard practice among the billionaire class. According to tax data analyzed by economists Emmanuel Saez and Gabriel Zucman, the 400 wealthiest American families paid an average tax rate of 23% in 2018, lower than the bottom half of households. Saez and Zucman, The Triumph of Injustice, 2019. By 2021, when ProPublica released its investigation, the evidence was undeniable. Between 2014 and 2018, the 25 richest Americans saw their wealth increase by $401 billion, while paying just $13.6 billion in federal income taxes, a true tax rate of 3.4%. The mechanism is surprisingly simple. Wealthy individuals hold assets that appreciate. Instead of selling and paying capital gains tax, they borrow money using those assets as collateral. They live off borrowed money, which isn't taxable. When they die, their heirs inherit the assets at current market value through a provision called stepped-up basis, erasing all the accumulated gains. The loans are paid off from the estate, and the cycle begins again. This strategy is known informally as buy, borrow, die. The ProPublica investigation was based on IRS data covering thousands of the wealthiest Americans over 15 years. The data showed that Jeff Bezos reported losing money in 2007 and 2011, despite his wealth increasing by billions, allowing him to claim and receive a tax credit for his children. ProPublica, June 2021. Elon Musk reported an income of just over $68,000 in 2015, while his wealth grew exponentially, resulting in a minimal federal tax bill. Warren Buffett acknowledged publicly that his tax rate was lower than his secretary's, calling the system unfair. These revelations were confirmed by multiple independent analyses. The Institute on Taxation and Economic Policy verified that America's wealthiest households pay far lower effective tax rates than middle-class families when wealth growth is included. The Congressional Budget Office has documented how capital income, which makes up most billionaire wealth increases, faces lower tax rates than labor income. Academic research from Berkeley economists found that the top 0.1% of earners pay an average effective tax rate barely higher than working-class households. Tax attorneys and wealth managers confirm to financial journalists that the strategies revealed by ProPublica are standard practice and entirely legal. The wealthy use charitable remainder trusts, family-limited partnerships, and qualified small business stock exclusions to further minimize taxes. These aren't secret techniques. They're openly discussed in white papers published by major law firms and wealth management companies. Defenders of the current system argue that unrealized gains shouldn't be taxed because they're not actual income until assets are sold. They point out that wealth on paper can disappear if markets crash, and taxing something that might vanish creates accounting nightmares. Some economists argue that billionaires do eventually pay taxes when they sell assets or through estate taxes, making the ProPublica analysis misleading. Others note that the wealthy create jobs and drive innovation, and that higher taxes might push them to move assets offshore or reduce investment. Conservative think tanks like the Tax Foundation argue that the top 1% already pays 40% of all federal income taxes, a higher share than ever before. They claim focusing on tax rates rather than total revenue collected distorts the debate. There are legitimate questions about how to tax wealth that exists primarily on paper without creating economic disruption. Some argue that comparing wealth growth to income taxes mixes two incompatible concepts. The debate also involves disagreement about whether stepped-up basis serves important purposes in allowing family businesses to transfer between generations without forced sales. The consequences of this tax structure fall hardest on ordinary workers and underfunded public systems. When billionaires legally avoid taxes, the revenue gap gets filled by payroll taxes on wages, sales taxes on purchases, and cuts to public services. A teacher in Ohio pays 15 to 20% of their income in federal taxes, plus payroll taxes, plus state and local taxes. Their total tax burden can reach 30% or more. Meanwhile, someone whose wealth grew by $5 billion might pay less than 2% when borrowing against assets. This creates a system where work is taxed heavily, but wealth accumulation is taxed lightly. Healthcare workers, construction laborers, and small business owners pay higher effective rates than people who make money simply by owning assets. The gap has real effects. Underfunded schools lack resources. Infrastructure crumbles. Social programs face constant pressure to cut benefits, while wealth concentrates at levels not seen since the 1920s. Young people entering the workforce see a system where income from labor faces immediate taxation, while income from inherited wealth compounds tax-free across generations. The psychological impact matters too. When people lose faith that the system is fair, social trust erodes and political polarization intensifies. Think of the tax system like a highway toll. Most drivers pay every time they pass through. But some drivers discovered that if they never technically complete their journey, they never hit a toll booth. They just keep driving on borrowed road passes, and when they die, their children get a fresh start with no record of the distance traveled. That's essentially how billionaire tax avoidance works. The deeper issue is a tax code designed for a 20th century economy now operating in a 21st century financial system. When income tax was created, wealth and income were closely linked. Rich people earned salaries or sold assets regularly. Today, wealth can grow infinitely without ever converting to taxable income. A billionaire can control vast resources and live luxuriously while reporting minimal taxable events. This matters beyond fairness. When societies have extreme wealth concentration combined with low taxation of that wealth, historical patterns suggest political instability follows. The system creates incentives that favor passive wealth accumulation over productive labor. An engineer who invents something pays higher taxes than an heir who inherits stock. A doctor pays more than someone who borrows against appreciated assets. The code doesn't reward contribution. It rewards ownership. So here's what we know. The wealthiest Americans legally pay minimal federal income taxes by holding appreciating assets, borrowing against them, and passing them to heirs with tax advantages that erase accumulated gains. This isn't illegal. It's built into the system through provisions that date back decades but now enable unprecedented wealth accumulation with minimal taxation. What we don't know is whether reform is politically possible. Powerful interests benefit from the current structure and have successfully blocked changes for years. Now we arrive at the final question: what happens next? Several reform proposals have gained attention but face uncertain prospects. President Biden proposed taxing unrealized gains for households worth over $100 million. But the plan stalled in Congress amid concerns about implementation complexity and opposition from both parties. White House Budget Proposals 2023. The likelihood of passing a wealth tax in the current political environment remains low. More realistic is incremental change. Some proposals would close the stepped-up basis loophole, so inherited assets carry their original cost basis, forcing eventual taxation. Others would treat loans secured by assets over a certain threshold as taxable events. The confidence level for these moderate reforms is medium. They have bipartisan intellectual support, but face intense lobbying opposition. States like Washington and California have explored their own wealth taxes with mixed results, creating a patchwork that wealthy individuals can navigate by changing residence. International coordination through OECD initiatives on tax transparency shows promise but moves slowly. High confidence that debate continues. Medium confidence that minor reforms pass within 5 years. Low confidence that fundamental restructuring occurs without major political realignment. The most likely scenario is continued public awareness and incremental policy adjustments, rather than revolutionary change. The system will probably evolve slowly, through a combination of IRS enforcement improvements, targeted loophole closures, and new transparency requirements, rather than a wholesale reimagining of how wealth is taxed. The billionaire tax illusion reveals something profound about how modern economies work. The rules aren't hidden, they're just written in a language most people never learn to read. Whether this system represents sophisticated financial planning or a fundamental betrayal of tax, fairness depends largely on where you sit in the wealth distribution. If you want to understand how this connects to broader economic inequality, watch our next video exploring why wages stopped growing while productivity soared. Another piece of the same puzzle about who captures the wealth that economies create. Source notes and disclaimer. This script draws primarily from ProPublica's June 2021 investigative series, The Secret IRS Files. Academic research by Emmanuel Sayers and Gabriel Zuckman, published in The Triumph of Injustice, 2019. Congressional Budget Office reports on effective tax rates, and verified reporting from the New York Times, Wall Street Journal, and Washington Post on tax policy between 2019 and 2024. Tax laws vary by jurisdiction and change over time. This video provides educational overview, not financial or legal advice. We update information as new developments occur and welcome factual corrections supported by credible sources.